Hi, everyone, and welcome. So, you know how we go for an annual health checkup, right? The doctor runs a few tests to see how we're doing, checks our vitals. Well, businesses need that exact same thing. And for them, that checkup is called financial statements. Today, we're going to learn how to read a business's report card line by line.
So here's our plan. We'll start with the big why. Why do businesses even need this report card? Then, we'll cover the basic rules for how money gets sorted. After that, we'll dive into the two big reports, the performance review and the financial snapshot. We'll even see how simply organizing the report can tell a different story. And finally, we'll see how it all sets the stage for the business's next chapter. All right, first things first. Before we get lost in all the numbers and the jargon, let's just ask the most basic question. Why does any of this even matter? What's the real point of putting together these reports? I mean, think about it. How can you tell if a business is truly doing well? You might see huge sales, which sounds great, but what if their expenses are even bigger? Or maybe they have a lot of cash in the bank, but what if they also have massive loans to pay back? See, just one piece of information doesn't give you the full picture. You need a proper, standardized way to measure success, and that is exactly what financial statements are for. And what's really fascinating is that different people look at the same report card for totally different reasons. The owner, they want to know, am I making money? Is my investment growing? But a bank is thinking, can they pay back my loan? The manager is looking at day-to-day performance, while the government just wants to make sure the right amount of tax is being paid. So one set of reports has to answer all these very different, very important questions. Okay, so before we can even start building these reports, we have to learn the number one rule of the game. You see, not all money is treated the same. We absolutely have to classify every single transaction correctly. And that big rule is telling the difference between capital and revenue items. Think of it this way. If you buy a big new machine that's going to help you make products for the next 10 years, that's a capital item. It's a long-term investment. But paying the monthly electricity bill, that's a revenue item. It's just a short-term cost to keep the business running right now. Getting this difference right is the foundation for everything that follows. All right, let's get into our first major diagnostic tool, the profit and loss account, or as it's famously called, the P&L. This is where we answer that all-important question. Did we actually make any money this year? It tells the story of how the business performed over a whole period of time. And this is such a great way to think about it, isn't it? A treadmill test measures how your heart performs over a period of stress. Well, the P&L does the same for a business's finances over an entire year. It's not a single snapshot, it's more like a video of the year's financial journey. So, the very first number we look for in our review is the gross profit. This is profit at its most basic level. It answers one simple question. Did we sell our stuff for more than it cost us to buy or make it? It's that first fundamental check on whether the core business idea even works. Okay, once we have the gross profit, we dig a little deeper to find the operating profit. To get this, we subtract all the costs of actually running the business. Things like salaries, rent, marketing. This gives us a much clearer picture of how profitable the main day-to-day business is, even before we think about things like loan interest or taxes. And finally, we get to the one everyone talks about, the bottom line, or net profit. This is the real deal. It's what's left over after every single expense has been paid. Operating costs, interest, taxes, everything. This is the ultimate measure of profitability, and it's the profit that truly belongs to the owners of the business. So when you look at the format, you can see it's a really logical flow. We start with all the money that came in from sales, then we start subtracting things. First, the cost of goods to get gross profit, then the operating expenses to get operating profit. And we keep going until we reach that final number at the very bottom, the net profit or loss. Okay, so that was the treadmill test, a look at performance over time. But what about the business's health at one single moment? For that, we need a totally different tool. Let's talk about the balance sheet. Exactly. If the P&L was the video, the balance sheet is a financial X-ray. It's not about performance over a year. It's a frozen snapshot. It shows us the exact financial condition of the business on one specific day, say midnight on the 31st of March. What does the business own and what does it owe right at that moment? And here's the magic rule of the balance sheet. It has to balance, always, no exceptions. On one side, you have assets, which is everything the business owns. On the other side, you have liabilities and capital, which shows where the money came from to buy those assets. The equation is simple. What you own must equal what you owe plus what was invested. This is what it typically looks like. On the left, we list the sources of the money, like capital from the owners or loans from a bank. And on the right, we show where that money went, the assets it was used to buy, like furniture, inventory, or just cash in the bank. And here's a real example that makes it all clear. Take a look at Ankit's business. See the total at the bottom? The left side, liabilities and capital, adds up to 36,500 rupees. And the right side, assets, adds up to, you guessed it, exactly 36,500 rupees. If those two numbers don't match, you know there's a mistake somewhere. That balance is non-negotiable. Okay, we've got the P&L and the balance sheet. We have all the right numbers, but here's where it's really clever. How you organize those numbers can actually change the story the report tells. The layout isn't just random, it's a strategic choice. And this strategic organization has a name. It's called marshalling. All it means is arranging your assets and liabilities in a specific, logical order. The two most popular ways are by permanence, where you put the most long-term, stable things first, and by liquidity, where you list the items that can be turned into cash the quickest first. So just by changing the order, you tell a different story. If you arrange it by permanence, you're highlighting the solid, long-term foundation of the business, its buildings, its machinery. But if you arrange it by liquidity, you're highlighting its agility, how quickly it can access cash to pay bills. The information is identical, but the emphasis, the story, is totally different. So we've done the annual checkup, we've got our performance review and our financial x-ray. But you know what? This isn't the end. Not at all. It's actually the beginning of the next story. Think of it like this. The balance sheet is a bridge connecting one year to the next. The final numbers on the last day of this year don't just vanish. They become the starting numbers for the very first day of the new year. This official handover is done through something called an opening entry, and it ensures the financial story of the business continues seamlessly. And that leaves us with one final thought. If every set of financial statements is a chapter in a business's life story, then the opening entry is the first sentence of the very next chapter. So the real question is, based on the report we've just read, what kind of story is this business about to tell next?